Well, the price of gold trading at all-time high levels, breaking through 2,400. Our next guest says this and rallies in other areas of the market like copper and energy are and can be historically the early warnings of a recession or bear market. Chris Vermeulen is the founder and chief investment officer at Technical Traders, and he joins me now. Chris, thanks so much for being with me. And I think that's the question of the day, is we're trying to get a sense of what signals are some of these things sending us, the rally in gold, maybe the sell-off in the bond market. Is it inconsistent with continued gains for equities?
Yeah, I mean, there's a lot of warning signs out there. I think the equities market's getting pretty overheated. We're seeing gold, a lot of defensive plays really starting to move up, precious metals, silver, miners. The fact that we're seeing gold push higher along with the US dollar index itself is definitely a sign that there's a lot of global fear. People are trying to move to safety. And, we've got wars going on. We've got a lot of different stuff that is actually bullish for gold and for energy itself. And typically, when we get to late stage of a bull market, which I believe we're in, we tend to see precious metals, energy stocks, and industrial stocks do very well. And all three of those have come to life. They're taking off, and they're really holding their value and leading the way. And it's an early warning sign that I think we're going to have some difficult times later this year.
So I understand why gold would be an early warning sign, but energy, industrial goods, you need that when the economy is working and firing on all cylinders. So how does that reconcile with a recession around the corner?
Yeah, well, typically, I mean, we've got wars going on that naturally spurs on higher energy pricing. But when it comes to industrials, there's a big delay, companies have really good years. COVID was obviously very good for a lot of companies. It sent them higher. But industrials, when people upgrading their assembly lines, their equipment, machines, all their capital goods, there's huge delays in those happening. And a lot of CEOs will expand, and they're planning for this growth that they've had to continue to keep going. But really, they don't realize, I think, we're coming to the end of a growth cycle, and the music's about to stop. But industrial stocks have just continued to muscle their way higher. They're hitting all-time highs, and that is a sign that we're going to see these companies eventually start to slow down. And the thing is, industrials kind of lead the way. We see the industrials take off and rally. And typically the stock market or the investors who are buying into these actually upgrade right at the end of a growth cycle. So that's how this is kind of seen as a warning sign.
Let's take a look at the chart of the S&P, and I'd love to get your technical perspective on where the levels are then. So if you're worried about a pullback, let's talk how steep it could be. Where's support?
Yeah, the S&P 500 is holding up fairly well. We've obviously seen most of the indexes pull back a little bit, but it's still in a strong uptrend at this point. I think we could see potentially another 5-6% to the downside before maybe it finds a bottom. We're really at a critical turning point, really across the board for a lot of equities and important stocks like Apple and Tesla, Nvidia. Those are really going to play a big role in how the markets move. But right now we're seeing a lot of fear in the market. The VIX is high. We've got the put call ratio has been fairly high, meaning people are betting on options using leverage. They're betting on falling prices. Typically, when we see panic and we see fear in the market, we usually see some type of bottom. And all the major indexes are flirting with the 50-day moving average, which is typically a level that we find a bounce and a support from this. So I think we're very close to potentially having another leg up. I do believe we could push higher into May, June, and then I think maybe we'll run out of steam there. But right now, it's obviously a wave of selling. We've been seeing some distribution selling, meaning we're seeing big institutions unload where almost everything goes down in value with high volume. And we've been seeing a few of these this year. Now that the indexes are hitting new highs, we're starting to see this pick up more and more where institutions are unloading. And that is an early warning sign as well that I think people, big money managers, are seeing the music might be coming to an end here soon, and they want to lighten up their portfolios.
I want to contrast that view with historical analysis from Sam Stovall, who's kind of the keeper of the data, as you know. And he said there's been 24 corrections since World War II. Each time it typically takes around 4 months to recover, to break even. Recently, since the 90s, it's only taken about 3 months. Have these corrections become, sharp but short, right? And I guess history is, you want to buy those pretty much every time you've wanted to buy those.
Yeah, I mean, we've been in one of the longest bull markets. It's really, if you just buy the dip, I mean, you've been doing okay. But eventually we go into a bear market or a stage 4 decline, which is a financial reset. The tech bubble was a stage 4. The 2008 financial bubble was a stage 4 decline. I believe we're starting into another one. And, after the tech bubble, the NASDAQ took 16 years to come back. Took the SP 500 12 years to come back. 2008, it took many, many years to come back as well. And I think something very big, and it's going to delay a lot of people's returns. It's going to hurt a lot of retirements. It's going to be a lot of pain of people watching their wealth potentially go down 30, 40, 50% over the next year. And of course, it's going to take forever to recover, several years. So I think we're coming into a major market top, more or less a financial reset, which is not a bad thing. It's short-term, temporarily painful, but we need the markets to reset. We need regular pullbacks and corrections for the market to keep going up. We don't want something to just keep going straight up like Nvidia, because what goes straight up typically wants to come straight back down.
Do you see a risk of a material fall in Nvidia? Because again, the point has been made since the launch of ChatGPT, it's pulled back 10%, like 9 times.
Yeah, I mean, it's still kind of in bubble phase, and there's still a feeding frenzy of people piling into that sector. The AI space has got so much potential to the upside. The chart is still very bullish for Nvidia. These pullbacks really are nothing more than just a pullback at this point. The big question is, does the stock market have one more push and rally over the next couple of months, which I think it might, and Nvidia will continue to move higher because Nvidia is in a bull flag pattern, and there's a little bit of fear creeping in with earnings. With Nvidia, we saw a big pullback just before earnings last quarter, and I think we'll probably see something similar like that again. But overall, it is in a very strong uptrend. You don't want to try to pick a top when something has got the mass market moving in. It really is still a sector that is in the infancy stage. It's really tip of the iceberg how big Nvidia and the whole AI space can actually get. So definitely don't want to get in front of it. If anything, you want to be long it still.